Hi, everyone, and welcome back to Canada Accounting Insights. Today, we're going to break down some really important topics that show up both in practice and on CPA exams: consignment arrangements, sales with right of return, rebates, and volume discounts. If you're a CPA student, an accountant, or even a business owner trying to make sense of revenue recognition rules, this video will help you understand the concepts in a simple, practical way. And at the end of the video, you will find all the journal entries for each of these situations. But before we jump in, don't forget to like this video, subscribe to the channel, and hit that notification bell so you don't miss out on future lessons. All right, let's get started. First up, consignment arrangements. Here's the basic idea. In a consignment, the seller, let's call them the consignor, ships goods to another party, the consignee, who agrees to sell the goods on behalf of the consignor. The key point here is that control of the goods does not pass to the consignee. The consignor still owns the goods until they're actually sold to the final customer. That means, and this is really important, revenue is not recognized when goods are shipped to the consignee. Instead, revenue is recognized only when the consignee makes a sale to the end customer. Let's see an example. Imagine Company A sends 500 laptops to a retailer on consignment. The retailer doesn't buy those laptops outright. Instead, Company A records revenue only when the retailer actually sells each laptop to a customer. This is different from a normal sale because risks and rewards of ownership haven't been transferred until that final step. Okay, next, let's talk about sales with a right of return. In many industries, think electronics, fashion, or even online retail, customers often have the right to return products if they're not satisfied. Under accounting standards, revenue is recognized only when it is probable that significant reversals will not occur. That means companies need to estimate returns and adjust revenue accordingly. So, when a sale happens with a right of return, the seller records revenue for the amount expected to be kept by customers and a refund liability for the estimated returns. Plus, they keep the inventory related to those expected returns on the books. Example: a clothing store sells $10,000 worth of jackets in December, but based on past experience, they expect 10% will be returned. In that case, they only recognize $9,000 as revenue and set up a $1,000 refund liability. This approach makes sure the financial statements reflect the most realistic outcome. All right, now, let's move into rebates. Rebates are discounts or partial refunds that sellers give back to buyers, usually after a purchase. They can be tied to volume, timing, or even promotional campaigns. The important thing here is that rebates reduce the transaction price, meaning the amount of revenue recognized must already factor in the expected rebate. For example, suppose a company sells $100,000 worth of products and offers a 5% rebate if the customer pays within 30 days. If management expects the customer to take advantage of that rebate, they record revenue at $95,000, not the full $100,000. So in practice, companies need to assess rebates carefully. Are they likely? Are they conditional? Do they depend on future sales? All of these factors influence how much revenue can be recognized up front. Closely related to rebates are volume discounts. These are price reductions based on the amount a customer purchases over time. For instance, a supplier might say, if you buy over 10,000 units this year, you'll get a 10% discount. Again, this affects the transaction price. Revenue has to reflect the price the company ultimately expects to receive after considering the discount. For example, if a customer buys 1,000 units at $10 each, that's $10,000 in revenue. But if the seller expects the customer to reach the threshold for a 10% discount by year end, they need to reduce revenue to $9,000, because that's the net amount the seller is entitled to. This prevents overstating revenue early in the year, only to adjust it down later when the discount kicks in. So, let's tie it all together with some key points you'll want to remember. Consignment arrangements. Revenue recognized only when the consignee sells to the final customer. Sales with right of return. Record revenue net of expected returns, plus a refund liability. Rebates. Adjust the transaction price for the expected rebate. Volume discounts. Factor in likely future discounts when recognizing revenue. In every case, the focus is on whether control has transferred and how much consideration the seller is entitled to keep. And that's it for today's lesson on consignment arrangements, sales with right of return, rebates, and volume discounts. These topics might sound technical, but once you connect them to real-life examples, they become much easier to digest. That's why I prepared cases with journal entries for each of the situations you just learned. If you found this helpful, make sure to like the video, subscribe to Canada Accounting Insights, and share this with a friend or colleague who's also preparing for their CPA exams or working in accounting. Thanks for watching, and I'll see you in the next video where we'll continue making accounting concepts simple and practical.